Simon, I want to get your opinion on a recent FT comment piece that said the best indicators of a country's future economy is where its citizens are keeping their assets, whether they're at home or overseas. So what do you make of this?
This stems from the concern from the Chinese economy of capital flight, which could be anything between maybe 500 billion and $1 trillion in the last 12 months. And that is concerning the global economy and policymakers because of the impact that the Chinese authorities will have to have on selling their almost 4 trillion, although now down to 3.3 trillion of US dollar foreign exchange reserves, to maintain the yuan US dollar cross rate, which they want to depreciate at a very slow rate. Now, clearly, if we get capital flight, and the calculus amongst Chinese citizens is that the investment returns are better outside China than within China, then that just accelerates that process. So for me, the FT comment piece is very salient. It's absolutely a thing to be looking at. And international capital flows has to be a thing within the investor toolkit to understand, US Treasury yields, the impacts of China currency flows, things that are materially affecting equity markets this year.
So bearing this in mind, what are the markets to watch?
Yeah, so for me, it's around the timing of US Fed fund rate rises in 2016. The famous dot plot, the thing we look at every time the FOMC meet, that has 4 interest rate rises penciled in for 2016 and all the way up to 3.25% in US rates by the end of 2018. I think that, quite frankly, is overly optimistic on the underlying strength of the US economy, which cannot decouple from the rest of the world, which is still loosening its monetary policy. You look at the PBOC, we're expecting interest rate cuts this year. ECB will continue its QE program. The BOJ will continue its QE program. To expect the US to be the sole economy that goes in the opposite direction at that speed, I think is overly ambitious. What therefore investors are looking for is that diversion trade and how that will affect currency risks. I think currency risks are a key part, particularly for UK-based investors, where sterling and sterling's volatility in recent sessions has really focused people's attentions on where those corporates are getting their revenues from and what the value of that revenue will be if sterling is all over the place in 2016.